today's video, we'll delve into the 3 best tech stocks to buy in 2024. So before we start, if you find value in this video, please support our channel by liking and subscribing to our weekly updates. Now, let's get started. Over the past year, investors' interest in tech stocks has surged dramatically, fueled by the excitement around artificial intelligence, AI. This buzz has pushed broader market indexes to unprecedented highs. Economic experts share this enthusiasm, viewing AI as a game-changing development, perhaps the most significant since the Industrial Revolution. As companies race to harness AI's potential, it's crucial to identify those with a sustainable competitive edge or moat. Morningstar analysts are particularly bullish on Alphabet Inc., Amazon.com, Inc., and Meta Platforms, Inc. These tech giants are believed to have a wide moat, indicating their ability to maintain a competitive advantage for the next 2 decades. Let's start with tech stock number 1, Alphabet Incorporation, ticker Google. The parent company of Google boasts an impressive market cap of $2.1 trillion. Based in Mountain View, California, Alphabet has grown far beyond its origins as a search engine. Its wide range of services, including Gmail, Google Drive, Google Maps, Google Photos, and YouTube, are integral to daily life. Beyond its dominance in search, Alphabet is leveraging AI across its product suite, enhancing its capabilities and user experience. Over the past 52 weeks, Alphabet's shares have climbed 37.7%, outperforming the S&P 500 index, which returned 24.4% in the same period. On April 25th, Alphabet announced its first-ever quarterly dividend of $0.20 per share, payable on June 17th. Additionally, the company's board approved a $70 billion share buyback on the same day. From a valuation perspective, Alphabet's stock trades at 23.18 times forward earnings, which is below its 5-year average of 25.65x. Alphabet also reported robust Q1 earnings, with revenue increasing 15.4% year-over-year to $80.5 billion, surpassing estimates by 2.3%. Its earnings per share, EPS of 1.89, rose 61.5% annually, beating forecasts by 26.9%. The company's advertising and cloud segments showed significant growth, with revenues rising by 13% and 28.4% respectively. This strong performance and the dividend announcement sent Alphabet's shares up 10.2% on April 26. Analysts predict Alphabet's profit will increase by 31.2% year-over-year to $7.61 per share in fiscal 2024, and rise another 13.7% to $8.65 per share in fiscal 2025. Morningstar analyst Michael Hodel highlights Alphabet's dominance in online search, holding over 90% of the global market share. He emphasizes the company's robust cash flow and its potential for sustained growth, particularly in search and cloud services driven by AI. Alphabet stock is rated as a strong buy overall. Of the 44 analysts covering the stock, 35 recommend a strong buy, 3 advise a moderate buy, and 6 suggest a hold. The average analyst price target is $194.89, indicating a potential upside of 12.9% from current levels, with a high target of $225, suggesting an upside of nearly 30.4%. In addition to its financial strength and market dominance, Alphabet continues to innovate and expand its offerings. The company's investment in AI has resulted in advancements like Google Assistant, which has become an essential tool for millions of users. Google Cloud's AI capabilities are also a significant growth driver, attracting enterprises looking to harness AI for their operations. Alphabet's diverse revenue streams provide stability and growth potential. The company's advertising business remains robust, supported by its leading position in search and YouTube's growing influence in digital advertising. Furthermore, Alphabet's Other Bets segment, which includes projects like Waymo, autonomous driving technology, and Verily, life sciences, offers long-term growth prospects. The integration of AI into Alphabet's ecosystem not only enhances user experience, but also drives efficiency and innovation. By embedding AI into services like Google Photos, which uses machine learning to organize and enhance photos, and Google Maps, which provides real-time traffic updates and personalized recommendations, Alphabet ensures it stays ahead of the competition. But before we proceed to the next stock, here's a quick question. Do you think Alphabet's AI advancements will keep boosting their stock price? Or is it time for a reality check? Share your thoughts below. Moving on to tech stock number 2, Amazon.com, Incorporation, ticker AMZN. Amazon, with a market cap of $1.9 trillion, is based in Washington and has diversified its operations across various industries. While renowned for its dominance in retail, Amazon has also made significant strides in entertainment with Amazon Prime Video, Amazon Music, Prime Gaming, and Twitch. Additionally, its Amazon Web Services, AWS segment, has become a leader in cloud and AI services. Amazon's shares have surged nearly 46% over the past 52 weeks, outperforming the S&P 500. The stock trades at 38.62 times forward earnings, a discount compared to its 5-year average of 183.17 times. On April 30th, Amazon reported its Q1 earnings, exceeding Wall Street's expectations on both the top and bottom lines. Net sales increased by 12.5% year-over-year to $143.3 billion, and adjusted EPS of $1.13 surpassed projections by 36.1%. Amazon's AWS segment was a standout, with net sales up 17.3% annually. CEO Andy Jassy highlighted the renewal of infrastructure modernization efforts and AWS's growing AI capabilities as key drivers of growth. For Q2, Amazon anticipates net sales between $144 billion and $149 billion, reflecting annual growth of 7% to 11%, with operating income projected between $10 billion and $14 billion. Analysts expect Amazon's profit to reach $4.72 per share in fiscal 2024, up 66.2% year-over-year, and rise another 22.9% to $5.80 per share in fiscal 2025. Morningstar analyst Dan Romanoff notes Amazon's dominance in e-commerce and cloud services, with strong demand across its business units. Amazon stock also holds a consensus strong buy rating. Out of the 46 analysts covering the stock, 42 recommend a strong buy, 3 suggest a moderate buy, and 1 advises a hold. The average analyst price target of $220.29 indicates a potential upside of 24.8%, with a high target of $246, suggesting an upside of 39.4%. Amazon's success is driven by its relentless focus on customer satisfaction and innovation. The company's Prime membership program, offering benefits like free shipping, streaming services, and exclusive deals, has built a loyal customer base. Amazon's logistics network, with its extensive network of fulfillment centers and delivery services, sets it apart from competitors and ensures timely deliveries. AWS continues to be a powerhouse for Amazon, contributing significantly to its profitability. The cloud division's ability to offer scalable, secure, and cost-effective solutions attracts a diverse range of clients, from startups to large enterprises. AWS's AI services, such as machine learning models and data analytics tools, enable businesses to harness the power of AI to drive innovation and efficiency. Amazon's commitment to innovation extends to emerging technologies. The company is exploring opportunities in areas like autonomous vehicles through its investment in Zoox and its drone delivery service, Amazon Prime Air. These initiatives demonstrate Amazon's forward-thinking approach and its willingness to invest in the future. Finally, we have tech stock number 3, Meta Platforms Incorporation, ticker Meta. Meta Platforms, the world's largest social media company, has a market cap of $1.2 trillion. Based in California, Meta has revolutionized social media since Facebook's debut in 2004. Through its apps like Messenger, Instagram, and WhatsApp, Meta has extended its global reach. The company is now venturing into augmented and virtual reality, leading the next phase of social technology. Over the past 52 weeks, Meta's shares have surged nearly 77%. Significantly outperforming the S&P 500. On May 30th, Meta declared its second-ever quarterly dividend of $0.50 per share, payable on June 26. The annualized dividend of 2 euros translates to a 0.42% yield. Meta reported stronger than expected Q1 earnings on April 24th, with revenue of $36.5 billion, up 27.3% year-over-year, and EPS of 4.71. A 114.1% increase, exceeding projections by almost 9%. The company held approximately $58.12 billion in liquid assets as of March 31st, with free cash flow surging to $12.5 billion. Founder and CEO Mark Zuckerberg commented on Meta's Q1 performance, highlighting the new version of Meta AI and its applications. He noted the healthy growth across Meta's apps and steady progress in building the metaverse. For Q2, Meta projects total revenue between $36.5 billion and $39 billion. For fiscal 2024, the company expects capital expenditures between $35 billion and $40 billion, up from previous estimates, reflecting significant investments in AI research and development. Analysts project Meta's profit to increase by 35.8% year-over-year to $20.19 per share in fiscal 2024, and grow another 14.7% to $23.15 per share in fiscal 2025. Morningstar analyst Hodel notes Meta's ability to boost user engagement through new features and apps, which increases data collection for targeted advertising. Meta stock has a consensus strong buy rating. Of the 46 analysts covering the stock, 40 recommend a strong buy, 1 suggests a moderate buy, 3 advise a hold, and 2 recommend a strong sell. The average analyst price target is $520.05, indicating a potential upside of 11.34%, with a high target of $600 suggesting an upside of 28.4%. Meta's ability to innovate and adapt has been key to its success. The company's investments in augmented reality, AR, and virtual reality, VR technologies through its Oculus brand position it at the forefront of the next wave of digital interaction. The development of the metaverse, of virtual shared space, represents a significant growth opportunity for Meta as it seeks to create immersive social experiences. Meta's robust advertising business remains a cornerstone of its revenue model. By leveraging its vast user base and extensive data, Meta can offer highly targeted advertising solutions that drive value for businesses. The company's focus on enhancing user experience through new features and continuous improvements ensures it remains a dominant player in the social media landscape. Moreover, Meta's commitment to privacy and security is critical in maintaining user trust. The company has implemented measures to protect user data and provide transparency, addressing concerns that have arisen in recent years. This focus on trust and safety is essential for sustaining long-term growth and user engagement. Examining the recent performance and future outlook of Alphabet, Amazon, and Meta, it's evident these tech giants are well-positioned for sustained growth. Alphabet's impressive revenue growth, robust financial performance, and significant AI advancements highlight its strong market position. Amazon continues to thrive with its dominant e-commerce and cloud services, supported by relentless innovation and customer focus. Meta's ambitious ventures into AR, VR, and the metaverse, coupled with its robust advertising business, underscore its growth potential. Each company's strategic initiatives and strong financial health make them attractive long-term investments for those looking to capitalize on the tech industry's transformative trends. As we wrap up, here's something to ponder. Which tech stock do you think has the most potential for growth in 2024? And why? Let's hear your thoughts in the comments. That wraps up our analysis of the top 3 tech stocks to buy in 2024. Alphabet, Amazon, and Meta platforms are all well positioned to leverage AI advancements and maintain their competitive edges, making them excellent choices for investors seeking long-term growth. If you enjoyed this video, please like and subscribe for more content. Remember, this video is for informational purposes only and does not constitute financial advice. Thanks for watching Simple Investing Secrets, and we'll see you in the next video.